Most people hear index funds and ETFs and think they're the same thing. They're not. And if you're putting your money into either one without knowing the difference, you could be paying more fees, losing more to taxes, and missing out on better returns without even realizing it. Today, breaking down exactly what each one is, how they actually differ, and most importantly, which one you should buy based on your situation. Let's get into it. Welcome back to Cash Flow Hacks, where we make investing simple, real, and actually useful. If you're new here, subscribe right now. We drop money content every week that your school never taught you. First, let's kill the biggest myth. Most people think index funds and ETFs are totally different products. Here's the truth. An ETF is often a type of index fund, and most index funds are structured as ETFs. The real distinction is structural. Traditional index funds are mutual funds you buy and sell through the fund company at end-of-day prices, while ETFs trade on stock exchanges throughout the day, just like shares of stock. Same destination, different vehicles. Invest in engineers. What is an index fund? An index fund is a passive investment that simply tracks a market index like the S&P 500, which is the top 500 companies in America. Apple, Microsoft, Amazon, Google, all in one fund. The S&P 500 has historically returned around 10% per year since 1928. You don't pick stocks. You don't pay a fund manager. You just own a tiny piece of everything, and you grow with the market. Fidelity. And here's the wild part. 94% of large-cap U.S. funds underperformed the S&P 500 over 20 years. Professional fund managers, with all their research and resources, can't even beat a simple index. That's why creators like Graham Stephan and Andrei Jik, two of the biggest finance YouTubers in the world, both publicly invest heavily in index funds and ETFs. Now the 4 real differences you need to know. Difference 1: how you buy them. If you invest through a 401k or 403b at work, you'll almost always find index mutual funds as an option, but not ETFs. If you want ETFs, you typically need to open a Roth IRA or a brokerage account separately. So if you're investing through your employer right now, you're probably already in index funds, and that's totally fine. Banker to difference 2: trading flexibility. ETFs are generally better for people who want to trade more frequently. You can buy and sell shares throughout the trading day. Index mutual funds only price once at market close. For most long-term investors, this doesn't matter. But if you want flexibility, ETFs win here. Fidelity difference 3 fees. This one's close, but according to 2025 research from the investment company Institute, index equity mutual funds averaged an expense ratio of 0.05%, while index equity ETFs averaged 0.14%. However, ETFs also come with bid-ask spreads. Each time you trade an additional cost that index funds don't have. For a long-term buy and hold investor, this difference is tiny, but over 30 years, it adds up. Invest in Genja Finer Die for tax efficiency. This is where ETFs have a real edge. When ETF shares are sold, they're exchanged between buyers and sellers on the market rather than through the fund company, which means fewer taxable events are created inside the fund itself. For people in higher tax brackets investing in a taxable brokerage account, this matters a lot. So which one should you buy? Here's the honest answer. For most beginners, it doesn't matter as much as just starting. But here's a simple rule: if you're investing through your job's 401,000, stick with index mutual funds. Easy, automatic, done. If you're opening a Roth IRA or a brokerage account, go with ETFs. Lower costs, more flexibility, better tax efficiency. The Vanguard S&P 500 ETF, ticker VOO, is one of the most popular choices among serious long-term investors. VOO, VTI, QQ, and SCHD are currently among the top picks for 2025, each offering diversification, low fees, and reliable long-term growth. Mexican. If you're investing outside the US, like in Pakistan or anywhere abroad, ETFs are generally your most accessible option through platforms like Interactive Brokers or eToro. Here's the bottom line. The debate between index funds and ETFs is real, but it's not worth losing sleep over. Both are low cost. Both are passive. Both beat the majority of professional fund managers over the long run. For most investors, the right answer may even be a combination of both depending on your goals, your tax situation, and how you prefer to invest. Invesco's biggest mistake isn't choosing the wrong one. It's choosing neither and doing nothing. Drop in the comments, are you team index fund or team ETF? I read every single comment, and I want to know where you're at. If this helped you, smash that like button. It takes 1 second, and it genuinely helps this channel reach more people who need this. Subscribe if you haven't yet, and I'll see you in the next one. Let's keep that cash flowing.